Hi, I'm Anthony Holman, ETF Product Manager here at S&P Capital IQ, and today I'm joined by Todd Rosenbluth, our Director of ETF Research. Todd, thank you for joining us.
Good to be here, Anthony. Thanks.
Let's talk more about ETFs in particular. How has this market been growing?
Yeah, well, right now globally we have over 5,000 products in the exchange-traded product market and over 2.4, almost $2.5 trillion. We've really seen this growth over the last few years. So even though we have about 800 new products in the last nearly 3 years, we actually have over $1 trillion that have been invested in this, and it's coming from all around the globe, not only in US listed products, but all around in Europe and Asia and emerging markets.
And you touched upon it, most products in the ETF industry are US domiciled. How have some of the Asia Pacific products been faring over the last year or so?
Yeah, so you're right, about 70% of the marketplace is tied to US listed securities, whereas about 7% is tied to Asia Pacific. But we've seen a lot of growth within the Asia Pacific listed markets. In fact, the number of products has actually doubled in the last few years, much faster pace of product introduction in Asia Pacific than it is in the United States. But you add to that we've seen an increasing number of Asia Pacific investors investing in the US through ETFs, getting exposure to treasuries, getting exposure to sector investing, getting exposure to large cap US stocks, as well as other geographies outside of the United States because of the beauty of what the US listed products offer.
What's driving that Asian investor interest?
Yeah, we think it's actually similar to what we've seen for overall interest towards ETF assets. So ETFs are liquid, they're low cost, they're transparent, and they allow you to be as tactical as you need to be. So if you see changes in interest rates or you see changes in the global macroeconomy, you can use ETFs to gain exposure to that new asset class, new investment style, and move out of the other way of doing it. Instead of buying a handful of stocks to get representation to a marketplace, you can use a much more well-diversified ETF to get that in a very low-cost way.
Just talking about some of the characteristics of why a financial advisor would use an ETF in his or her client's portfolio. We know they're cheap, they're liquid. What are some other elements that you see as favorable for financial advisors to use?
Yeah, so in the United States, we've seen investors gravitate from individual stocks to more packaged products, and particularly mutual funds has been extremely popular the last couple of decades for the U.S. investor and for the U.S. financial advisor. But there's a lot of research, including from Standard & Poor's Dow Jones Indices, their index versus active product, SPIVA is what it is known, that shows that most active managers and most active mutual funds fail to outperform the index. And if you're going to fail to outperform the index and spend a lot of money to do so, when there's an ETF alternative, that just is really not good for your client. So we've seen a shift towards ETFs from the low cost, the transparent products that are out there towards the ETFs where they can really get strong opportunities to manage their client portfolios.
And do you think the way financial advisors get compensated plays a role in that selection process?
Yeah, that's another trend that's happened in the United States is we've seen financial advisors be paid less for the commissions for the trades that they're making, and more they get paid for the assets under management that they have and being good stewards of their investors' portfolios. That's probably how it should be, but what we've seen is lower cost ETFs. Instead of trying to be outperforming and failing, you can use the ETF in a low-cost way, and it fits very well as the commission structure has shifted away from trades and more getting paid from the overall assets under management and growing as your client's assets grow.
Sure. Let's talk more about flows. 2013, not a great year for fixed income overall, especially within the fixed income ETF market, but faring a bit better in 2014. Why is that?
Yeah, what we saw in the U.S. And actually globally as well is in 2013, interest rates moved higher. There was expectations that the Federal Reserve in the U.S. would start to taper, which has now taken place in 2014. But we saw a spike in interest rates in 2013. And actually in 2014, we've seen a pullback. A pullback in interest rates actually has given investors reason to go back into the fixed income ETF market. So U.S. Treasuries have done very well, but also investment grade and high yield bonds from the U.S. perspective have both done well as internationally, international products, those that are listed outside the United States. We think investors are going to continue to have diversification in their portfolio, but the growth of fixed income ETFs and the more options that investors have is encouraging as we've seen rates stabilize both in the U.S. and globally.
And you spoke just before about it, some of the products that are outside of the United States, even focused on Japan, have been gaining a lot of traction lately.
Yeah, so while the U.S. market or U.S. equities have not been in favor in 2014 from an ETF product perspective, we've really seen strong interest in developed non-U.S. markets, and that's been in Europe and that's been in Japan. Now, Japan did very well in 2013 but from a performance standpoint, and we've seen money continue to go into the Japanese ETF market, both U.S. listed and Asian listed products in 2014. And that's encouraging as investors want to have more exposure to Japanese equities using ETFs as their vehicle.
So fixed income, non-U.S. listed products with momentum there. How about some investing in sectors? That's been hot lately as well.
Yeah, so what we've seen is over $3 billion on a monthly basis has gone into sector-based products, particularly U.S. sector-based products, but not all of it is tied to that. Those are typically the largest are from State Street. They have the most liquid, often very low-cost products that give you exposure to large-cap stocks. We've seen investors using these products to be more tactical. So we saw more defensive sectors in 2013, like consumer staples, start off the year very strong, and then more economically sensitive sectors in the second half of the year, like technology, like industrials, really gained favor in 2013. In 2014, it's really been healthcare that's been leading the drive. There's the Affordable Care Act in the United States that is helping to drive things. Biotechnology is helping to drive things. Sure. And the healthcare sector spider is really a good way to get exposure to that. And we actually have a report that's available for attendees of the conference that they can get from S&P Capital IQ on this respective ETF.
That's great. What are some things that investors should keep top of mind when looking to select a particular exchange-traded fund?
Yeah, so let's even stay within sectors. You can see that that not all healthcare ETFs, not all consumer discretionary ETFs are the same. And even though they may sound the same, you need to really look inside. So most of the time, investors will start with the expense ratio and sometimes stop there. Cheaper is good, but cheaper isn't always better. You need to understand what's inside the portfolio, understand how the ETF trades, how liquid it is, understand the risks that are tied to it, because in sectors as well as other strategies as well, we've seen that just the name on it sometimes has an index, sometimes doesn't have an index behind or listed on the product. You may not know exactly what's inside unless you stopped and took a look. So if you're getting exposure to the U.S. market and you think you're getting everything that's the same because it's a U.S. large cap or a U.S. sector product, it's probably not the same, and you need to dig a little deeper. And that's something that we at S&P Capital IQ hope to help investors with.
I imagine that happens more from the not. Unfortunately, an investor will select something with a specific style that they either don't understand, or the particular product does something that the investor didn't think it was intended to do.
Yeah, so I mean, let's use another example of low volatility, which has become extremely popular as the S&P 500 and other indices have neared record highs. Investors want to stay in the market but not necessarily take the same level of risks. There's a couple of products that are out there that are U.S. listed in nature that take a look at volatility. One is from PowerShares and another one is from iShares. They have two different approaches to coming up with volatility. So the PowerShares product takes the least volatile stocks in the respective index and holds them regardless of their sector orientation. Whereas the iShares product, which is tied to an MSCI index, takes the least volatile stocks within a given sector. So there is more sector diversification, but they're investing in stocks that wouldn't necessarily meet that low volatility criteria of the first portfolio. Which is right for investors really comes down to their investment goals, but they sound the same, but they're not the same. And the PowerShares product is another one of those reports we have available at the back of the session.
Great. Thanks, Todd. This is great. Thank you for joining us and coming to talk to us about flows and ETFs in particular. And thank you to our audience for tuning in. If you'd like to learn more about our ETF research at S&P Capital IQ, you can do so by accessing one or two of the links below on your screen.